I think one of the biggest reasons people never start investing is because every time they open their phone and see the market is at an all-time high, their brain just shuts down. You look at the SP 500 and you think to yourself, okay, there is no way this can keep going up. This has to stop at some point. And then you tell yourself, well, I already missed the whole run, so I am just going to wait for the market to crash and then I will buy when everything feels safe again. And look, I totally get that because I used to be that exact same person when I was in my early 20s. I was broke, like genuinely broke. I was living paycheck to paycheck. I had credit card debt piling up. I had zero savings. I had no emergency fund. I had no clue what I was doing with my money. And every time I heard somebody talk about investing, I just tuned out because I thought it was something only rich people did. I thought you needed a finance degree or a ton of money to even get started, and the market always felt like it was way too high, so I just did nothing. And let me tell you, doing nothing is probably the worst financial decision you can make, because while you are sitting there waiting for the perfect moment, the market just keeps going. Years pass by and you have nothing to show for it. Right now, we are sitting in 2025, and the last real crash we had was 2022. Since then, the market has been on an absolute tear. Sure, we have had little dips here and there, like 5 to 10% drawdowns because of tariffs or geopolitical stuff, but nothing major, nothing like 20 or 30%. And that makes people even more nervous because the longer this bull run goes, the more they think the crash is going to be brutal. And I am not going to sit here and tell you the market is never going to crash again because that would be stupid. Of course it will crash. Markets always do. But here's the thing most people do not realize. The market actually spends a ton of its time near all-time highs. When we go through a bull run and the economy is doing well, it is completely normal for the market to hit new highs month after month after month. That is not unusual. That is literally how growth works. And those prices that feel terrifyingly expensive right now in a few years, you are going to look back and think, damn, that was such a good deal. I should have bought way more. So what we are going to talk about today is how do you actually invest when the market feels expensive? And I am going to be straight with you. Waiting for a crash is not the right move. You could be waiting for years, and by the time the market finally does crash, you would have been way better off just buying consistently the whole time. Before we get deeper into this, let me ask you something. Have you ever hesitated to invest because the market felt too high? Drop a comment and let me know, because I guarantee a lot of you have been in that situation. I know I have. After the COVID crash in 2020, I watched the market bounce back like nothing happened, and I felt like I missed the biggest opportunity of my life. And that feeling sucks. But since then, I have completely changed my mindset. Now I do not care if the market is up or down or sideways. I am always buying. Every single paycheck. That is what works for me, and that is what I want to help you build. So let us talk about why investing at all. Time highs feel so terrifying. The first thing you need to understand is that most people are emotional with their money, and that makes total sense. If you invest $10,000 and the market drops 25%, it does not feel good to see $2,500 disappear. You are investing to make money, not to lose it. So when the market is at an all-time high, your brain automatically flags it as danger. You think something bad is about to happen, something has to crash. But here is the reality. Hitting all-time highs is totally normal for a growing market. It is not a warning sign. It is just what happens when companies are making money and the economy is expanding. Yet people still tell themselves they are going to start investing after the next crash. Then the crash happens and they say, well, I am going to wait for it to bounce back a little first. And then before you know it, years go by and they have not invested a single dollar. That is analysis paralysis. And I have seen this happen to so many of my friends. They say they will buy the dip. Then the market drops 10% and they say they will wait for it to drop more. Then it drops 20% and they panic. Then it bounces back and they feel like they missed it again. It is an endless loop that keeps people out of the market forever. Here's something I really want you to think about. When you are investing consistently at all, time highs, your brain will tell you that you are late, that you are about to fall, that you already missed the big run-up. But nobody knows what is going to happen next. Not me, not you, not the so-called experts on YouTube. Nobody has a crystal ball. And if you are new to investing, social media makes this so much worse. You can go on YouTube right now during a good year and find 20 videos telling you a massive crash is coming. You will see thumbnails with red arrows and scary fonts. And that stuff gets inside your head. It makes you emotional and scared. And before you know it, you are stuck in that cycle, always waiting for the perfect entry point that never actually comes. I think one thing people need to understand is that the market is supposed to hit all-time highs. That is how it grows. When big companies have solid earnings and their value keeps going up, the stock market reflects that. Especially right now when the market is heavily driven by just a handful of mega cap companies. And people treat all-time highs like they are some super dangerous thing. But the truth is markets sit at all-time highs all the time. During bull runs, and if you believe the market is going to grow over the next 10, 20, or 30 years, then it has to keep hitting new highs. It cannot stay flat forever. That would mean no growth at all. Another thing I want you to consider is that today's all-time highs will probably not feel that expensive a few years from now. Think about somebody who invested right before the 2008 crash. If you look at the SP 500 peak from 2008, it looks tiny compared to today. Even the peak from October 2021 before the 2022 crash does not look high anymore. Every time you look at an all-time high, it feels terrifying in the moment. But years later, after the market bounces back, those old highs look cheap. And then you look back and think, damn, I should have bought more. That is what happens to almost everybody. People love to tell themselves that this time is different, but it is not different. The market has always had reasons to crash. Inflation wars, recessions, interest rates, there are 1,000 reasons every single year. But at the end of the day, if we have innovation and growing companies and advancing technology and rising corporate earnings, the market is going to keep going up over the long term. It is really that simple. Now, I am not saying the market will never crash again. It will. But I do believe markets trend up and to the right over long periods of time. They might crash for a year or two, but they always bounce back. History proves that over and over. So waiting for the perfect crash is a losing game. A lot of people feel smart when they talk about how overpriced the market is. Everybody sounds like a genius saying it is going to tank, but market timing does not work. And the reason is emotions. When you try to time the market, you have to be right twice, you have to sell at the peak and then buy back at the bottom. And the second part is way harder than the first. If the market drops 20%, is that the bottom? Or does it drop 25%, maybe 30%? You have no idea. And when the market is crashing, you see terrifying headlines everywhere. Recession fears, layoffs, economic collapse. And I know for a fact you are not going to sit there thinking this is a great time to buy. You panic, you think, what if it drops another 20%? What if this time is different? And then you wait for it to bounce back before you buy. But by the time you feel safe, the market is already way higher. Your emotions recover way slower than the market does. So you end up buying high and selling low. That is the opposite of what you want. Some people think holding cash is safer, but cash has risk too. Your cash loses value every year because of inflation, and you miss out on compounding and market growth. This year is a perfect example. The market sold off earlier in 2025, and a lot of people sat there with cash waiting for it to drop more. And now we are already back at all-time highs within a couple of months. That drop was nothing compared to a real crash where the market drops 20 or 30% over a year or two. Those crashes are long and painful, but even then the market bounces back. So how do you become a good investor? You cannot be emotional. That is the #1 rule. And the best way to become unemotional about investing is to be consistent. You do not have to be perfect. You just have to show up and buy consistently. Long-term investing works best for people who are super consistent, not the people trying to catch every dip, not the people trying to time the bottom. It is the people who just keep buying no matter what. Beginner investors obsess over timing way too much, but timing the market is always better than timing the market. If you miss the 10 best days in the market, your returns can be cut nearly in half. And those best days often happen right after big crashes when everyone is panicking. So if you sit out during the bad times, you miss the good times too. You also need to think about your time horizon. If you are investing for 20 years, you should not worry about a dip that lasts 2 years. As long as you believe the market will bounce back, you will be fine. Instead of stressing about timing, focus on your savings rate. How can you save more money? How can you invest more consistently? How can you stay invested for the long haul? That matters way more than finding the perfect entry point. Most wealthy investors did not get rich because they perfectly timed the market. They got rich because they stayed invested for decades. My personal strategy is dollar cost averaging. I invest a certain amount every single paycheck. Whether the market is up or down, I just buy, and if you can automate this, it makes it so much easier. When you put money into your 401k, it leaves your paycheck before you even see it. You do not have to think about it. You can do the same with your brokerage account. Set up an automatic transfer that pulls $50 or $100 every week and invests it. That way it becomes a system, becomes automatic. And yeah, it might feel boring after a while, but boring works. Boring builds wealth. A lot of people consume too much market news. They let headlines get into their head and they move their money around constantly. But every time you sell a stock at a gain, you get taxed. If you do not hold it for more than a year, you pay higher short-term capital gains taxes. And you are playing the timing game where you have to be right twice. So just automate it. Dollar cost average, have a system that will make you way less emotional, and that is how you build real wealth. If your investing timeline is 15, 20, 30, or 40 years today, S prices are not going to matter at all. Look at prices from 2005 or 2007 or the dot-com bubble. Peak, they all look tiny compared to today. So I dollar cost average. Every time I get paid, I put money in. Whether it is a lot or a little does not matter. I just need to be consistent. Nobody knows what the market will do next, so do not pretend you do. Focus on what you can control. Your income, can you get a side hustle? Can you job hop? Can you get a promotion? Do whatever you need to earn more money. Then focus on your savings rate. How much of your income are you saving and investing? Look at your expenses. Live beneath your means and avoid bad debt. Do not run up credit cards. Pay off high interest debt first. Market crashes are normal, but history tells us the market goes up more than it goes down. Even if it drops 30 or 40% over the next 2 years, tell yourself this is a good time to buy at a discount. The market will bounce back. It always does. In 35 or 7 years after a crash, you will regret not buying more, so embrace the dips. And if there is no crash, remember that today S peaks will look small in the long run. Every long-term investor gets mentally tested when the market drops. it is part of the journey. But I would rather spend decades participating in the market with all its ups and downs than spend decades waiting for the perfect time to jump in. That is just not a winning strategy, and that is how I approach investing at all. Time highs, that is it for me. I hope this helped you think about investing differently. If you enjoyed this video, drop a like down below and hit that subscribe button. I will see you in the next one. Peace.